let me start by thanking Stephen Mayor for a stimulating address, which is also a very good introduction to this panel. Our panel is about the transition from Libor and the other IBORs to risk-free rates. It's important that the market and the authorities work closely together on this. Working groups in the main IBOR jurisdictions now include the cash markets, including the bond markets, as well as the derivatives market, and that's welcome. And this panel is an opportunity for senior experts in the authorities involved to explain how this works and why it's important. So, we have on our panel, to my left, Edwin Schooling-Latter, Head of Markets Policy, Strategy and Competition at the Financial Conduct Authority in the UK. To Edwin's left, we have Ed Ocampo, Senior Advisor of Markets at the Bank of England. To Ed's left, we have Cornelia Holthausen, Deputy Director General at the European Central Bank. To Cornelia's left, we have David Bowman, Advisor to the Board of Governors of the Federal Reserve in the United States. And to David's left, we have Roman Baumann, Head of Money Markets at the Swiss National Bank. Thank you all for joining us for this important session today. And my first question, which I'm going to start with Edwin, is why is the transition from Libor and the other IBORs to risk-free rates important? And what progress has been made to date? And we're going to look at this from the point of view of the different jurisdictions represented on the panel. Edwin.
Thank you, Paul. Let me start by underlining something that Stephen actually mentioned too, and that is that the survival of Libor beyond end 2021 is highly uncertain. So if your business, like many, relies on that rate in some way, it cannot afford to continue to be reliant on Libor. If your business is one of those, and I think most in the room, if not all of them, will be, you need to be planning for and acting on your plans for transition to alternative interest rate benchmarks. Now, why is that? Stephen again touched on the key point, which is that the market which Libor has sought to measure over the years for unsecured term wholesale deposits simply does not exist in the same way that it used to. And to make that graphic, take an example of one of the currency tenor pairs in which a Libor rate is currently published every day. In the whole of 2016, the dozen or so panel banks which submit to that rate undertook just 15 transactions in the entire year in that currency and tenor and size. Now that's an extreme example, but the truth is that most of the Libor currency tenor pairs are sustained almost wholly, or at least in large part, by expert judgment, i.e. panel banks' best view on what a market would look like if it existed. Now that's clearly suboptimal, and it's also clearly highly uncomfortable for the panel banks. Beyond that, even if the market were there to measure, in most of the use cases for which Libor is now the norm, again Stephen touched on this, it's far from clear that it's really the benchmark you would choose if you had other choices. So for example, it is not a clean measure of the interest rate risk that most interest rate derivatives seek to hedge. Even in the cash markets, it's far from clear why most borrowers would want to be exposed to a variable bank credit risk element that means their interest payments will go up, all else equal, when economic conditions deteriorate. It doesn't make sense. So in that context, whilst the problems with Libor are not ones that the FCA has chosen, but in that context where the market it measures has changed to the point of disappearance and where the rate doesn't appear to be the right benchmark for most uses anyway, it clearly does not make the sense for the FCA to try and sustain it artificially through exercise of its influence and powers. And that is how it has been sustained in recent years, by us persuading panel banks to stay on the panels. We are not going to do that indefinitely. That means the challenge in front of us is one of transition. Now, in some markets, that will be relatively easy because, I say relatively easy, not easy, because the right and more appropriate benchmark rates are there, and it's self-evident to most participants in that market that they are a better choice. And indeed, whilst we are at early days, I think you can see some signs that that is beginning to happen. So to share with you some numbers that we've procured in our role as regulator, the share of SONIA, the SONIA-based share of cleared sterling interest rate swaps in the past 6 months on a duration-adjusted basis, SONIA tends to be at the shorter term, is around 16% of the total, 16.2%. But that is up from 10.7% just 9 months earlier. So we are seeing some movement. Now, I appreciate the challenges can be a bit greater in markets which have more dependence on term rates, and I'm sure we'll come back to that, but there are some early promising signs. The last introductory point I want to make, if I may, is to applaud how the industry are already stepping up to address the challenge and the task, the operational task, of making transition happen. So in the sterling risk-free rate working group, for example, there are over 120 firms already directly involved in its subgroups, its main group, and its fora in helping to address this challenge. In the bond market in particular, ICMA themselves have taken a leading role. That subgroup is working, for example, on documentation for SONIA-based floating rate notes. And in the derivative market, Scott O'Malia and his colleagues and members at ISDA have obviously done vitally important work on amending their documentation, including introducing fallback clauses that will help if LIBOR disappears before the legacy contract mass has entirely been reduced. So lots is being done, but there is a great deal more to do, and I suspect that most people in this room are going to need to be a part of that task in the years ahead.
Thank you, Edwin. That was a very helpful and useful introduction. Now, Ed Ocampo, the Bank of England's been heavily involved in the new risk-free rate for the UK, SONIA, and you've reformed SONIA very recently to make it more robust, and I think the market will be very interested in your comments on that and how far we've got as a result of the work that the bank has done.
Thank you, Paul. Yes, I'd be happy to talk a little bit about the sterling overnight interest average, or SONIA, which actually has been around in sterling markets since 1997. The bank took over administration of SONIA in 2016, and in April of 2018, we introduced important reforms to SONIA. Why did we do all that? A few reasons. Firstly, because, as has been mentioned by Edwin, SONIA is already a critical rate in sterling markets. It's deeply embedded into the fabric of sterling wholesale markets. It's the index that's used by the overnight interest rate swap market in sterling. It's the rate that's paid on cash margin for many applications. And it also forms the basis for the discount curve that's used to value derivative portfolios. So it's very important. We also chose to take action and take on administration of the rate because we knew that the market needed and would be looking for alternatives to Libor. And we wanted to make sure that the market had a choice, and had a choice of good, robust, and resilient benchmarks. Because prior to 2016, SONIA was administered by a private sector administrator, and it only covered a relatively small subset of the market. It didn't have a full coverage. So market participants told us that they were concerned about the resilience of the index and the robustness of that index. So what we have done is we take, so why didn't the market just reform it? The truth is that the bank is uniquely positioned, using our statutory powers under the Banking Act to be able to collect the data that we need to make SONIA truly robust, which is what we've done. We collect now granular data from over 50 deposit-taking institutions in the UK, which we think covers 95% of market activity. So we introduced reforms to SONIA using all of this data in April of this year. SONIA is now based on daily average volumes of around 50 billion in deposits and around 375 transactions a day on average. That's about 5 times the number of transactions that we picked up before. So we've gotten all of these reforms are subject to market consultation, and we've gotten very good feedback from the market that they're much more much happier with the index. And I think the biggest and most important demonstration of support for SONIA is the fact that the private sector risk-free rate working group last year, following their own market consultation, chose SONIA as their preferred alternative to sterling Libor.
Thank you, Ed. Cornelia, the European Central Bank has also recently been working very hard on the risk-free rate for the euro area. As Stephen referred to this earlier, could you bring us all up to date on where you've reached so far in choosing a risk-free rate for the euro area generally?
Yes, thank you, Paul. Stephen Mayo already explained very well the situation we are in the euro area. There's a very strong benchmark regulation that will become fully applicable as of January 2020. We have 2 critical benchmarks in the euro area, that is Ionia on the overnight segment and Euribor for the longer tenors. And as Stephen has already explained, EMI, together with the panel banks, have decided not to pursue the reform of Ionia that would make it benchmark compliant. And against this background, the ECB has also, the ECB has been monitoring the developments in Ionia for some time already. So in the past, there was a very strong panel contribution. The volumes were relatively high, but really since the Libor scandals, more and more banks have dropped out of the panel. It has become much less stable than before. And now we see that actually there are days when there's a holiday in some of the areas in the euro area in some countries, the volumes can drop to very low levels. So I think yesterday we have again had a volume of less than 1 billion on that day, because today is a public holiday in Frankfurt. And we have seen similar days like that in the past. And so the panel has become very unstable. And against this background, the ECB has indeed decided also to use its statistical data that it has been collecting since 2016 to provide an overnight unsecured rate, which will be called Esther, and it will be available probably in the second half of 2019. Now, this rate is based on borrowing transactions, unlike Ionia, which is based on lending transactions. Currently, the ECB collects data from 52 banks in the euro area. In the future, we may expand this panel, but already we think it captures the bulk of the market activity. It's an overnight rate, and we will now use then all these data available to construct the new rate. Then in parallel, and as Stephen has already said, we have jointly launched a private sector working group also for the euro area. And one of the first tasks of this working group will be to to agree on a risk-free rate for the euro area. And the working group has started and has already actually published some criteria for this rate last month. They're considering a wide range of rates from the start, unsecured and secured rates, and actually they will also have a public consultation coming out next month to be sure that really all the rates that could potentially fulfill this role are taken into account. So that's what the first work stream of this working group is dealing with. There are other work streams. There's one that looks then at a term structure to be developed potentially on this risk-free rate, and there's a third work stream that deals with the contractual robustness. That's the work stream ESMA is actually providing the secretariat for. The latter two work streams are not as far advanced yet, but it's also because we have a wider membership in this group. The first work stream is only with the banks that actually constitute the working group, whereas we have reached out to others, to other stakeholders in these other two groups. And of course, their work will then have to build on the risk-free rate that's chosen by the first work stream, which should take place later this year. So there's a lot going on, and I'm very grateful really to both the public institutions and the private institutions who are very engaged in this now.
Thank you, Cornelia. So we have Sonia in the UK. You've raised the question of Esther in the euro area. In the US, David, you have SOFA, and you've already made considerable progress on that with the ARC, and I think it would be very helpful for everybody here, this is the global audience, to hear about the US progress on the shift to risk-free rates.
Sure. Given this global audience, I want to echo what Edwin said. I know that some people might hope that the general risks to LIBOR that Edwin has laid out might somehow not apply to US dollar. It is not the case. Although there's roughly 200 trillion worth of contracts written on US dollar LIBOR, on most days there's only about 500 million underlying 3-month US dollar LIBOR, which is most heavily used. And that is on a good day. There are many days where there might be only 100 million, some of them predictable. And that's based on the current number of panel banks submitting. If the number of panel banks goes down, that number goes down. And 2 banks have actually left the US dollar panel over the past 2 years prior to the agreement hopefully obtained by FCA and Andrew Bailey. So this is a financial stability risk in that people have written a massive number of poorly structured contracts on a fairly weak rate. LIBOR can stop, even US dollar LIBOR can stop, and financial market participants have not prepared for this. The contracts, as they're structured now, are not prepared for a stop to US dollar LIBOR. So US authorities have seen this for a number of years as a financial stability risk, a clear one, not just in the US, but a global financial stability risk. And so I hope that you will pay attention to this. Seeing these risks, and I think there's no way to escape them, in 2014, the Federal Reserve convened the Alternative Reference Rates Committee, or ARC. So I tend to think of it as Noah's Ark, in a way, because if the flood comes, you're going to need to get on that ark. At the time, I think people thought we were crazy. Many of the original ARC members were polite and nodded when we said, there are risks to LIBOR, it could stop. Over time, I think they've come to believe us. When we convened the ARC in 2014, we had a few basic things we wanted them to do. We wanted them to identify a robust alternative to US dollar LIBOR. And we wanted them to create a plan to promote its use on a voluntary basis. We also wanted them to think about contract robustness because it was clear to us that the contracts that had written on LIBOR had not envisioned that LIBOR could ever stop, and were not in any way robust enough to withstand a LIBOR stop. They achieved the things that we originally asked of them. So neither of the rates that the ARC ultimately nominated as its main competitors actually existed when we formed the ARC. The Federal Reserve, working in partnership with the private sector, created both the final front runners, the overnight bank funding rate, which is an unsecured rate, and the secured overnight financing rate, which is an overnight treasury repo rate. The secured overnight financing rate, SOFR, is the rate that was ultimately chosen in the US. It is different from some of the other jurisdictions, but there were good reasons why the US went for a secured approach. One is the overnight unsecured market in the US. Although there are a fair number of transactions in it, it's heavily concentrated, it's fairly specialized. 95% or more of Fed funds trades involve one set of federal home loan banks lending cash in. So it's very concentrated, and it's mostly due to an arbitrage trade in the US. So it's not, although there are many transactions, it's not nearly as robust as the repo market is. And so in the US, we chose SOFR. We also came up with a plan to promote the use of SOFR on a voluntary basis. That's called the PACE Transition Plan. And it involves moving price alignment, interest, and discounting to SOFR over time. Because in either, whatever rate the ARC chose, it was going to be a new rate. We had a special set of difficulties or challenges in terms of, we had to build this market at the same time realizing the risk that LIBOR could stop. And we are beginning to build the market. So SOFR began production in April of this year. Futures were started on it by CME a month later. And volumes and interest are gradually growing. I think they're fully in line with my expectations. They're actually outpacing the start of either the Fed funds contract, Fed funds futures contract, or the Eurodollar futures contract at this time in their livelihoods. So, I'm happy with the development of SOFR, but it is a challenge for, that the US is going to have to make sure that we continue to develop it. Now, at the time that the ARC had achieved these things, Andrew gave his speech, and suddenly a lot more people became interested in mitigating the risk to LIBOR. So this year we reconstituted the ARC. You can call it ARC 2.0. It's a very diverse group. There are 27 firms, banks, buy-side infrastructures, and many associations. In terms of what we're focusing on, we are focusing on the development of SOFR markets, certainly SOFR derivatives markets, and hopefully over time SOFR cash markets. And we're making a big push on contract robustness. So ISDA is leading the charge in terms of contract robustness on derivatives. The ARC is leading the charge in terms of strengthening contract language around the use of LIBOR in cash products. And that's been an area of real focus to us, because the sooner you get better contract language in, the sooner you begin to mitigate your risks to LIBOR. The longer you wait, the more you just simply propagate bad contract language and more risk into the financial system. So that's the reason that we're pushing for it. Either you get better contract language in, the only other way to mitigate your risk to LIBOR is to close out. And there are some large firms in the US who I think are leaning towards the closeout alternative here. So that's where we're at.
Thank you, David. Very helpful exposition. And also, Roman, the Swiss National Bank has taken the lead with the market in producing Saron in Switzerland, and you've already done that. Perhaps you could say a word about how you've achieved that in Switzerland.
I mean, obviously the Swiss franc market is by far the smallest one represented here in the panel, but it is an interesting case because we're already looking back on a small scale transition, as you mentioned, Paul. In the old days, our OAS market was based on something called TOIS, which was a panel-based, unsecured, Tom Next rate. And once the issues with LIBOR started to emerge, we had banks exiting that panel to a stage where it wasn't sustainable anymore. At that point, in 2013, we created our national working group on Swiss franc reference rates, looking at ways to make toys more sustainable. And pretty quickly became clear it actually wasn't possible, so we started to move on. And the obvious alternative, as you have mentioned, was SARON. SARON is a rate based on our interbank repo market, on the platform operated by SIX, which is our infrastructure provider. They're also administrating that rate. It uses both transaction as well as binding quotes. Has been around for nearly 10 years now, and our national working group recommended a transition from toys to SARON, which basically took place in the course of last year. And at the end of last year, we were able to discontinue, or the administrator was able to discontinue toys without any type of market disruptions. Now, what have you learned out of that? A key point was we had to get the most important market participants at the table. This was easy, relatively easy in the case of toys because it wasn't widely used. It was mainly used for PAI calculations, so mainly professional market participants. It was quite easy to get virtually everybody on the table who was using that product. But still, it was very important to have the market participants in charge and leading the process. What was very helpful was a final deadline, a final end date to toys. Once the toys administrator announced the discontinuation of the rate, things started to move. So in the course of last year, an OAS market started to develop. The clearinghouses switched their PAI calculations in autumn last year, which was very important. Clearing started on this contract, and we could move on pretty quickly. Now, our national working group is looking at the LIBOR transition. It was also slightly adjusted because obviously it's a much broader audience that it basically affects everybody acting or active in financial markets. We have created 2 subgroups looking at the details, and now we are discussing the same type of questions David has mentioned, the same type of questions that in all jurisdictions have to be looked at.
Thank you, Roman. The bond markets, and many people here are working in the bond markets, use term LIBOR at the moment as a reference rate, and there is a big issue about how that should be replaced, and work on it is beginning. But would you like to comment, Edwin, and I'll ask Ed as well, on what progress has been made to date?
Thank you. So, as you say, Paul, in terms of the sterling floating rate bond market, most of those bonds reference a term version of LIBOR, so 1 month or 3 month or 6 month. And we have definitely heard, as part of the sterling risk-free rate working groups, that is a feature which some issuers at least attach importance to, so they like to know 1 month or 3 months or 6 months in advance what the coupon payments are going to be, and operationally a setup in that way. But for me, it's a really fascinating question, and many of you in the audience will be able to answer this better than I can, as to whether that's likely to remain the case in the future. Because it's very striking when we talk to some of the large issuers, at least, that the reason they give for issuing LIBOR-related floating notes is not because of the term rate, or that's what they want, but because that's the cheapest. Liquidity concentrated in LIBOR-related instruments, including in derivative markets, of course. Therefore, the tighter spreads and the cheapest hedges are for LIBOR-related floating notes. But I think we're looking at a future world in which liquidity is concentrated in SONIA and ESTR and SOFA and SARON-related instruments instead, and the cheapest hedges and so on will be in those reference rates. So it'd be fascinating to see the degree to which that changes issuers' behaviour. And we certainly have issuers who are saying, we will be issuing OIS referencing floating rate notes, not LIBOR ones in the future. Now that might be easier for some issuers and more sophisticated ones than for others. I don't know, but it's really interesting to see how market practice changes.
Ed, would you like to add to that?
Yeah, just to say that that there are a couple of things to consider in public securities markets. In terms of the use of risk-free rates, one side is conceptual and the other side is practical. Some of the practical issues I think Edwin touched on. On the conceptual side, in my own point of view, I think risk-free rates offer a lot of benefits and are very applicable. I mean, a risk-free rate like Sonia gives a very pure and clean measure on the general level of interest rates. It doesn't have a credit spread component. It doesn't have a funding liquidity component. It doesn't have other sort of technical factors that can impact other rates. It is very clean and useful in that way. By comparison, LIBOR is a rate that measures bank funding costs, and you know, if you think about it from the standpoint of an issuer, for example, a supranational issuer issuing an FRN, I can't think of any conceptual reason why they would need to tie their funding cost to the general level at which banks are funding. That link doesn't need to be there. It's just, I think, a historical accident. The practical problem is there are huge network externalities, or what economists would call it, network externalities, to move off of LIBOR. The liquidity is one issue. Liquidity issue is one issue. The other is that the systems and the infrastructure that support global capital markets today are set up to support LIBOR resets, LIBOR payments, and they're not set up to support a risk-free rate infrastructure. Conceptually, I think that can happen. I think that there are conceptual benefits to doing so, but we shouldn't kid ourselves that it's going to be easy. It will take a lot of work by market participants, including the market participants in this room. And Paul, I just want to say from the bank's point of view that we're really grateful for the work that you're leading, you know, as part of the risk-free rate working group. You're leading a very important working group to try and give insights on these issues. You know, what are the answers? How can we move forward? How can we get to a market structure that will support a new ecosystem based on risk-free rates?
Thank you, Ed. Cornelia, in the euro area, you have your IBOR at the moment. There's a question, obviously, about whether you reform it or replace it. Could you tell the market about where you've reached on that question? It's early days at the moment.
Sure. So Stephen Mayo already mentioned that the initial attempts to reform Euribor to make it purely transaction-based failed because of the by now well-known lack of transactions in many of the tenors. And now EMI is doing another attempt to reform it. It's called a hybrid methodology because it should be based on transactions as much as possible. But in case there are not sufficiently many transactions available, there would be a waterfall approach similar to LIBOR actually. So they would look at similar rates, and then ultimately they would also need to have some expert judgment. Now, EMI is currently collecting data to test the methodology, and I would hope that later this year they will also issue a public consultation on the proposed methodology. And I must say I'm hoping very much that this reform will be successful because with the benchmark regulation kicking in 2020 and with the current Euribor not fulfilling the requirements for this regulation, what would we have in 2020? So if the reform is not successful. So I really do hope that it is. Now that being said, some of the shortcomings of Euribor are similar to those of LIBOR. So we will have to see in the long run what would happen. And in any case, it's really important that also into Euribor contracts, fallbacks are introduced similar to LIBOR, that would make sure that we will always have something in place. So that's one part that the working group is also working on in the euro area.
Thank you, Cornelia. David, in the US, term reference rates, are they a big issue, and where have you reached with the ARC in the US?
They are an issue. Just to go back for a moment, in terms of whether many markets can handle a risk-free rate, I think people forget that LIBOR itself was marketed as a risk-free rate before the crisis. So as it spread into derivatives and floating rate notes, the argument was LIBOR is the best measurement of a risk-free rate. Now views have changed, but I think it's important to remember that. So all of the currency areas have chosen overnight rates because those are the only markets with enough transactions to support a market-based rate, nearly in any way robust enough to handle the volumes that are involved in LIBOR. That's clearly true in the United States. Now, for derivatives, we are of the view that most derivatives can go to an OIS-style environment. That's something that derivative markets already know how to do, and that will work quite well, I think. For cash products, there are many people that are used to a term rate and who have had systems built to reference a forward-looking term rate. For that reason, to help with the transition, the ARC did incorporate the end goal of producing a term rate based off SOFR futures or OIS markets. So it would be a risk-free term rate. It would really be primarily designed for cash products, and only some of them, not for derivatives in any size, but we think it is important. Now, one thing to say is this rate, while it will help some people, this term rate is really kind of a front end. Behind it will be the SOFR futures or SOFR OIS market running the engine. And as a front end, it can provide convenience, but it will be a bit more expensive to use because you'll have to hedge it in the underlying OIS market. And therefore, I would expect that some larger players, say financial floating rate notes, some of the larger, on the buy side, some of the larger asset managers will find it cheaper and more convenient to go to an overnight rate environment. So in the note space, I would expect there to be a mix with some of the larger, more sophisticated players going to an overnight environment and others who are really, at this point, unable to adjust their systems using the term rate.
Thank you, David. Is this an issue, Roman, in Switzerland, a term rate, or not an issue for you?
Yeah, of course it is. Bond market, the direct impact on the bond market is less of an issue in our case, as the floating rate market is not that important as it is in other markets. But obviously we have a large retail mortgage area linked to LIBOR, and there we have exactly, obviously there you need any type of term component. I would like to fully echo what David has said. Conceptually speaking, you don't need a term rate. In most cases, for most of the products you can easily do, obviously you're not setting a 3-month mortgage every 3 months on the actual overnight rate, that makes no sense. But having a compounding over that period works for most of the products actually, and it's the cleanest and most reliable version that we have, and I think we should strongly focus on that. Now, maybe just one quick note, I mentioned that the bond market is not the focus in our case. This is only true for the direct link. Obviously, for the indirect link, it is absolutely key. I mean, we all know, you all know in this room how important it is, if you're trading bonds, to have any type of pricing reference, to have a backbone. And in a lot of markets, this backbone is provided by the LIBOR-based swap market. And much more so in Switzerland on a relative basis than it is in other markets, because we do not have a liquid sovereign or government bond curve that could actually play the role as a backbone. So if you take that out and don't replace it with something liquid, you're questioning the functioning of the entire capital market. So we need a swap curve, a liquid swap curve to serve as such a backbone. Now the point is this can easily be done by an OAS curve. There is no reason why you need a LIBOR-based swap curve for that. but we need to be able to move the liquidity kind of from the LIBOR-based swap space to the OAS space based on these new risk-free reference rates.
Thank you, Roman. For the market, international coordination is very important, and that's partly an issue about the relationship between a changeover in the bond market and the derivatives market, but it's also an issue about the relationship between the different LIBOR and IBOR jurisdictions. And I think it would be helpful, Edwin, if you could just say a word about how the different jurisdictions, those represented here, come together through the official sector steering group.
Thank you. Well, I hope you get a sense from the discussion today and also from the substance of what you see from the ARC and from the Sterling Risk-Free Rate Working and other working groups that there is a lot of coordination. David and I speak so often that when we pick up the phone we don't even bother saying hello anymore. But maybe I can just give a little flavour of the institutional framework for that cooperation. So a key part of that is the Financial Stability Board. That has an official sector steering group as a subgroup of it. It's actually co-chaired at the moment by Jay Powell and Andrew Bailey of the FCA. That has been meeting regularly and continues to meet regularly. It produces public updates on its work. You can find those on the FSB website. And I think all of us here are involved in the work of the OSSG, as the acronym goes. There is also coordination on the IOSCO side. In fact, I chair IOSCO's board's benchmark task force. And as Stephen mentioned, there's a good deal of coordination through the EU, through ESMA, and indeed through the colleges that we have for the critical benchmarks. So lots and lots of places where important coordination is taking place.
Thank you. And that includes, Cornelia, the European Central Bank as well, and the Bank of England. So national central banks, European Central Bank, Federal Reserve, Swiss National Bank, and of course the UK regulator together. Did you want to add on that,
Yes,
Cornelia?
and of course the private sector working groups,
Yeah.
they are also coordinating. So there's some cross-membership, first of all, and
Yeah.
then secondly, so since our group started a bit later than the other groups, I must say that we can also greatly leverage on what the other groups have already achieved. And so our members, I think they look very closely at what is published from the other groups to learn from it and to seek feedback.
And you'd agree with that, Ed?
Completely. I just do want to make one point, which is that coordination is critical. It doesn't mean we need to move in lockstep.
Yeah.
And in fact, for example, in sterling markets, because the SONIA market is more developed, the OIS market is more developed, we have the opportunity to move more quickly, and it would be wrong of us not to take those steps, as long as we're doing it in a coordinated way, and we're making sure that we're not setting precedents that would be inappropriate in the global context.
So coordination does not mean the same. I mean, you'd agree with that, David, I think.
No, I do. We have been very coordinated, even though we chose, in some cases, different kinds of rates. So I think that the theory, the execution is very coordinated. As Ed said, the timing and the specifics can differ across countries as is appropriate.
Thank you. Now, time is running out, but I would like to ask you each briefly in turn what messages you want to convey to the market about the importance of preparing and starting to prepare now for the shift to risk-free rates. Edwin, let me start with you and then go along.
So as I said at the beginning, you need to be ready for the disappearance of LIBOR, and you need to be putting in place transition to alternative interest rate benchmarks. Now that obviously means knowing and understanding where you have financial exposures to LIBOR, asset or liability side, and also operational exposures, if you like, and making sure you're operationally ready for the alternatives. If you are a financial firm supervised by the FCA, for example, you need to be ready for supervisors to arrive at some point and say, have you prepared for this? Show us your plans. What do they look like? I know Bill Dudley mentioned last week that the same questions are likely to come for firms supervised by the US authorities. There will also be questions if you are on selling and so on LIBOR-related products about whether you have assessed the suitability of those and explained the issues around them to customers, given the uncertainty over the survival of LIBOR beyond end 2021. I think if you're an issuer, you clearly need to make sure you are not left behind if the market moves if and when, probably, the market moves to alternative interest rate benchmarks.
Ed, anything to add?
Just to say that there are 26 participants in our risk-free working group. There's over 100 different institutions that have since volunteered to be involved in technical working groups. Decisions will be made over the next 4 years. Actions will happen. All of you have a choice. Get involved. Help drive this forward. And I think you'll be better prepared if you do that, or decisions will happen anyway, and you're going to have to adjust to that later on in a shorter period of time.
Thank you, Ed. Cornelia.
Let me focus on Ionia. That's the most critical issue for the euro area. Ionia will cease to be available for new contracts as of 2020. So whichever rate the working group on risk-free rates for in euro will recommend later this year, a shift needs to be made within the year after that. So that time is very, very short, because this involves also the move from derivatives contracts that are currently linked to Ionia to the new rate. So that's a huge effort that needs to be made across many different market segments. And
Thank
all
you.
of you probably need to be involved.
Thank you, Cornelia. David.
Yeah, I would say don't just assume that LIBOR is going to continue, because it would be convenient for you if it did. Assess your risk, seek to mitigate it, either get better contracts or close out. And think about what you're doing when you write a LIBOR contract. So there are 70-year floating rate notes and 50-year swaps or 30-year swaps. And I don't know what a 30 or 20 or 70-year LIBOR contract means in a world where LIBOR can stop. And so I think you all ought to think about that. I think you ought to think about your hedging and your accounting strategies around LIBOR and control your risk.
Thank you, David. Roman.
Just quickly following up on that, 2021 might sound like a date very far away. It's not. It's definitely not. We have to get going now, otherwise time will be running out, and then things could get really messy.
Well, there's a very clear message for you. We at ICMA, as you know, are heavily involved in this exercise on the transition to risk-free rates. We will be keeping you informed, and we will want to consult you and listen carefully to your feedback. But now I would like to thank the panel, Edwin, Ed, Cornelia, David, and Roman, and please show your appreciation. Thank you.